So hello, everybody. Good evening. Thank you for coming out. We're gonna get started. Today we're gonna do sort of a beginner's class. Depending on who's really on today, who's really beginner, we might be able to get more advanced. But I really wanted to touch upon the basics and like for like the beginners. All right. So now I'm gonna share my screen, and what we're gonna do, we're gonna go over like different terms and stuff. All right. Let's see. Share my screen. All right. You guys see my screen. All right. I'm just gonna get a cup of water real quick. I'll be right back. All right. I look like I just went to a different planet, but so if you guys see my screen, we have to go over some of these terms, but hold on. I think I want to back it up. Yeah. All right, this one. All right. So can somebody tell me what is the difference between investing and trading? Anybody? The answer's kind of there too. Anybody know what's the difference between trading and investing? Well, if you look, you guys will see investing is long term. So if you're investing, you're buying stocks, you're buying crypto, you're not really looking at it too often. You're doing it for the long term, and you're not concerned about the short term fluctuations. All right. So when you're buying stocks, for example, you want to do some fundamental analysis. You want to look at the fundamentals. So you're looking at how good is the company doing, so that long term, do I see a positive outlook? You know, trading, we're more short term, we're more quick, we're more maybe a month, maybe a week, maybe that's swing trade. Anything more than a day, that's a swing trade. All right. So trading, we do technical analysis. That's when we look at the charts and all that, supply and demand, resistance, support and resistance. So what we do is trading. All right. So do you guys understand the difference between investing and trading? Probably don't need to stay on this too long. Go ahead.
Yeah.
You guys got it? All right. So we're trading. But here's what I would tell you guys. You guys want to also invest and trade because it's cool to make these flips. But what do you do? What is your plan with that money in the end? You want to put your money in something that is going to make money while you sleep. So this is why we invest in stocks. All right. So moving on. Like I was saying, with the stocks, you're looking at the stock to find what is the intrinsic value. Intrinsic value is what is the company really worth? Yeah, it says it's worth this much, but what's the real worth of the company? You know, you guys understand that? All right. So when you're investing, you're gonna analyze the internal and the external forces that could affect the stock price. You know, like Tesla,
Like you're literally in the middle of
make sure you
cooking.
mute your screen coming in, guys. Yeah. So like I was saying, this is when you're looking at fundamentals. You're looking at accounting, you're looking at all that. But if you're only looking at technicals, you're trading. You're looking at the charts. All right. So now let's keep going. You guys understand the difference between a bull market and bear market. Like I know you guys are a little bit more advanced than complete beginner, but you guys know the bulls is going up, bears going down. Simple as that. All right. Yeah, we did that. All right, so these are the terms that I really want to touch. So volatility. Someone tell me, what is volatility again? What is volatility?
How much is going up and down? How much is moving up and down?
Yep, how much is moving. So options, we care all about volatility. Volatility is the bread and butter of options. Implied volatility to be exact. Because think about it, if you're buying a stock, you just want it to go up. But with options, you have time. By what time is it gonna go up by? By how much is it gonna go up by what time? So that all is an expectation, and that's where we make our money based off of what is the expectation on the market. All right. So you even see right here, play volatile markets are risky, but can be extremely lucrative. So it's risky, but you can make a lot of money off of it. So liquidity. Somebody tell me, what is liquidity? These are the most important two right here: volatility and liquidity. If you're an options trader, these are the two important things that you look for. The most two important things. All right. So can anybody tell me what is liquidity? It's how easily you can get in and out of trades. All right. But you got to understand, in order to be able to easily get in and out of trades, there has to be enough buyers and sellers to facilitate the trade. You understand? So if you get in a position where there's barely any buyers and you're trying to sell something, is that liquid or not?
Not.
It's not liquid. So the number one thing you want to make sure is you get into liquid trades, because if you do not get into a liquid trade, you won't be able to get out. Has anybody ever been trapped in the option before? You guys ever experienced that or no?
No.
No, well, it's possible to get trapped in the option. Like, for example, let's say you pick something like way out the money, like super out the money, where there's nobody buying it. You're gonna be the only buyer. You know what I mean? So that's why we pick things that are very liquid. All right. We gotta make sure they're very liquid. I didn't do the bid ask spread. That's what I wanted to show you guys. Hold on. You guys still see my screen? Hold on. Switch my screen.
Yeah, we can see it.
All right, let me I'm gonna try to move this on top of it. Hey, you guys see what I just pulled up right now?
Yeah.
All right, let me go to all right, this right here. So how do you know if something is liquid or not? The first way you can tell is the bid ask spread. Can somebody explain this to me, or do I need to?
Explain it.
Yeah, I wonder, does anybody know what the bid ask spread is? You know what it is?
No, I was saying explain it.
Oh, okay, copy. So remember, every single transaction in the market, there's a buyer and there's a seller. The bid is the price that people want to buy it at. You know what I mean? The ask is the price that they want to sell it at. You understand? So if you ever been to a yard sale, let me let somebody in real quick. All right, that's everybody. So if you ever been to a yard sale, right? You're gonna negotiate the price. You're not gonna just whatever price they tell you and then you buy it at that price. It's the same thing with the market. It's literally like a farmer's market or a yard sale in a way, because there's a price that people want to buy it at. So let's say you see that bike, I want to buy it for $5, right? But the yard seller is like, no, I'm selling it for 10. So what is that? That's a spread. That's a $5 spread right there. So what do? We meet in the middle and I buy it for 7. Is that clear?
Mm-hmm.
So that's all the spread is. So in order for you to know whether something is liquid, the tighter the spread, the more liquid it is. Because think about this. Let's say now, same yard sale, I want to buy this TV, right? So I say, let's say now I'm like, okay, I'll buy this TV for $25. I'll just say, yeah, $25, right? But you're like, no,
Mhm.
no, man, this is plasma, 1,000. Is that a tight spread or widespread?
It's a wide spread.
And do you think it's going to be hard for us to agree on the price?
Yeah.
So it's going to be hard to get in and out of that trade. It's the same
Right.
thing. It's the same thing. So you want to make sure that the number on the bid and the number on the ask is tight. That way, you know that there's a buyer for your seller and that you guys can actually agree on a price and actually get in and out. So this is the bid ask spread. Like I said, bid, that's the price I'm willing to pay for it. Ask, that's the price he wants to sell it to me for. All right. So that's the bid ask spread. All right. So now let me go back to the other one.
So in the option, like Apple, you go into, let's just say you go into a put option and the bid as spread is tight. I mean, it's liquid and it's right. Well, yeah, I mean, it's liquid.
It's liquid and you can get in and out of that trade easily. If it's not liquid, you can get stuck. Or you might have to sell it at a lower price in order for you to get it off. Make sense?
Mm-hmm.
So that's why it's so important. But I'll just show you an example real quick. And we'll load up. Here's an example. Let's just say this is an example.
You got Thinkswim. Oh no, you on Robinhood.
Yeah, I'm on Robinhood, but like this, Robinhood is more my play account, but you know, and it's easier. It's easier to show things, you know, much easier. Oh, let me go to you said Apple. Yeah,
But you can pick whatever one you want to do.
I'll do APL.
Do another XYL. I need to hit another one of them.
So yeah, XOY is interesting because the spreads be all over the place sometimes. So there's two ways to judge liquidity. We're gonna go over them right now. All right. So XLY, this has been a favorite for the past couple of weeks. I've made hundreds of percentages profits on this in the past 2-3 weeks. XLY, as you guys know, that's the consumer discretionary sector of the S&P 500. So all the Amazons, Home Depot, Tesla, consumer discretionary, that means that's the money that you have after you pay your bills. All that money is discretionary. So this is all the extra money that this is all the companies that take all the extra money that you make after you pay your bills. And, you know, it's a holiday season. So if you guys been watching it, it's been moving. Like just real quick, I'll just show you guys little. This is the 3 month.
And I moved up 3.
You guys see this? This is how it's been moving. But the point is to show you guys the spread. So let me not get caught up. But you guys can see like since October, it's been on the tier. Went from 180 to like 200. So you guys already know this is the option chain. Do you guys see all these options right here that says 1 cent? You guys see that?
Yep.
That's supposed to be my screen. So I already know without even clicking on them, these are terrible spreads. Because it wouldn't make sense for it to be for them to be selling it for $1. So what that tells me is that there's no buyers. Now let's just take a random look and see. Let's click on this one. What is the bid? Can somebody tell me what is the bid?
0.
That means there's 0 buyers. Now what is the ask?
I'm gonna say 27.
So there's 27 people that are trying to sell this for 95, but there's 0 buyers. So therefore, there's no price to sell this. There's no agreement. You know what I mean?
Mm-hmm.
There's no agreement. So this is an example of an illiquid option. You buy this option, you're gonna get stuck. You won't even be able to sell it. Understand? This is very important. So now if you slide down more, like you already know all these are really, really bad, right? So now we're gonna try to get close to some real numbers and see. So like right here, so now, yeah, right here, you see The 227 one, that's a penny. That's and then this one right here is also a penny. So let's act like this one right here. It's the and then look in here, you also see that this one's a penny. So you already know this is a terrible spread. Let's open it up. Look at the spread, 75 and 0. 227 people trying to sell this for 75. Nobody's answering, you know? So a
Mhm.
liquid option right there. But now it's interesting though, because look, this is more in the money than the 225. But let's look at the 225. There's buyers, but you see, they're trying to buy it at $1. But at least there's buyers. This is still illiquid. This is still an illiquid option. But at least there's some buyers. But you see, how are you gonna agree if I'm trying to buy it at $1 and they're trying to sell it at 78? In the middle was like what, 40 or something like that? You know what I mean?
Yeah.
Somewhere around there. So the maybe if someone's willing to sell it that low, we can get it off. So now, so these are all the bad options that you don't want to be buying. Now let's look at the liquid option. So as a rule, the more in the money you are, the more liquid it gets. Usually. So what? So let's look at a couple of these. So let's look at this one. This one is 9 and 19. So you see, it's a 10-cent spread, right? But the so if they were to meet in the middle, this would be like 15, 14, you know, 15 or 14 would be the mid price because it's gonna sell at the mid price. When there's both buyers and sellers, there has to be an agreement. They're gonna meet in the middle. All right. But
Mm.
the way you want to the one rule you could say is that you don't want to buy a you want the spread to be at least within 10%, 10% or less of the asking price. You see what I'm saying? So for example, this asking price is 19. So 10% would be like, 1.9, 2, basically 2. So this is more than 2 away from, the spread is bigger than 2. So it's not the most liquid. You know what I mean? So, but basically what I'm saying is that even though it's only 10 away, because the numbers are small, the percentage of the spread is too much. Because what happens is, let's say if you were to buy this at 19, you'd have to sell it at 14. So you're automatically losing money from the spread. Does that make sense?
Yeah.
All right. So now let's start to get a little bit more liquid. Let's look at these 212.5 calls. It's a little bit closer to the money. Now let's look at the spread, 49 and 62. So not only is it about, so this one's about 12, 13, about 13 cents apart. But since the numbers are bigger, it's a smaller percentage. So like I said, 10% of the asking price is 62. 10% of that would be 6.2. So it's a little bit more than 10% of the asking price, but it still is much better than the others. So you see the spread is getting better, it's somewhat decent. So the main thing is because these spreads are not the best, when I go to buy these, I don't try to buy the at 56. I try to buy it at a cheaper price just because I know the spread is gonna kill me, you know? So I would
Right.
try to limit order this at like 40 or something, you know? So now we're getting to like, so the price is 207. So we're getting close to near the money. So this is the last one that's out the money. Look at the spread. You got 107 and 23. Since the numbers are bigger, it's and then the numbers are somewhat near each other, you know that the spread is tighter. It's 20, but out of 1.23, 10% of that would be 12. So there, if you look at it, 7 minus 23, that's like 16. So it's close. It's close to 10%. Now let's
So
go.
if you're on Thinkorswim, the bid and ask obviously are going to be different just because of, the volume might be different from one platform to the next, correct?
Yeah, a little bit. Yeah, a little bit. Like it'll be close though. Like let's switch gears.
Because I'm looking at my Thinkorswim now, so I know some of the numbers were a little bit off on the
Yeah, they'll
last
be a little
one.
bit
When they're
off.
more out the money, those were there, but
And then
I was
Robinhood,
kind of checking the strike price to see.
yeah, and Robinhood always tries to overcharge you if they can. That's just Robinhood. Because when it comes to putting in the increments, like depending on the price of the stock, if it's too cheap, they'll make you do increments of 5. you know. But let me open Thinkswim and just show you guys on Thinkswim. It's really the same. But just to continue while I'm moving on my Thinkswim, let's look more in the money now. You're gonna notice in the money, the spreads are gonna get better. Usually you're gonna get a little bit better. So let's look at the 205. Look at this 205. You got 350 and 410. You know what I mean? But 10% of 410 would be about 40, 41. So you see it's about 60, 70. So it's not the best spread, but it's better than the others, at least. You know, it's better than some of the others. So like, so this was so now we're talking about liquidity. I'm just letting my Thinkswim load up. Hold on. I do want to show you guys on multiple platforms. Move a little slow, but I think it'll pop up. So to judge liquidity, you look at the spread. Now, let's say the spread is not the most favorable. The next thing you look at is the open interest and the volume. So let me just annotate. Right. So first you look at the spread, you know. I think my Thinkswim is just slowing. I think me trying to open the Thinkswim is slowing down my computer. I might have to just keep going. So right here. So let's say the spread is not as tight as you wanted it to be. The next thing you want to look at is your volume and your open interest. All right. So does anybody know what volume and open interest mean? Can anybody tell me? What do you want me to explain?
Open interest is how many people in that option, and the volume is how fast it's moving up and down, I guess.
Close. So the open interest is yeah, how many people are still in it? How many people still have contracts open? 79 people have this option. 79 people bought the 205 call and still have it open. Volume is how many were traded. So today, 120 contracts were bought and sold. Does it make sense?
Mm-hmm.
So the volume shows you the movement. The open interest shows you who has it. So let's say if the spread is not tight, then you want to have good volume and open interest, because at least then you can get people to come in and eventually tighten up the spread. You know?
How do you know what's good? How do you know what's good open interest?
Open interest. That's a good question. Like, I would say if I open interest, volume over open interest. Well, first of all, right? Because you can have people still have the contract, but that doesn't mean they're going to sell them. You know what I mean? They could just hold on to them and not even hold them. But I want things to be in the hundreds at least. You know what I mean? That's what I would say, in the hundreds, in the hundreds. You know, just that, but that's also contingent on how far the spread is. So like this one, for example, it's not that bad, because when you look at it, like it's about 60 cents, right? It's about 60-cent spread. Yeah, it's about 60-cent spread. And I said that a good spread is 10% of the ask, right? So that, okay, so I got about 10 minutes. Okay. So 10% of this is 41. You see what I'm saying? 41 cents. So this is a little bit more than 10%. That still is not a bad spread. But once it gets like past like 20% spreads, that's when you're really losing money, because you got to think about when you're selling it, when you buy it and you have to sell it back, you have to deal with the spread. And that's when you lose some money because of the spread. So let's say like so this spread is decent enough that these numbers don't even have to be that great. But if let's say this spread is bad, I would want these to be in the hundreds. Make sense? So if this was like $2 and this is $4, that's a huge spread. Now you see what I'm saying? So that's how you gauge liquidity. You want to make sure every option that you enter is liquid. That way you can exit. All right. So clear this. All right. Let me go back to the slideshow. The terms. All right. We got about 8 minutes. And again, the link to my coffee is in the chat. So we talked about volatility. We talked about liquidity, right? You guys know what gap ups and gap downs mean?
No, just go ahead and explain it. So we only got a couple of minutes.
Yeah, so gap up is when it opens above the closing price of yesterday. So let's say the stock closed yesterday at 20. Now tomorrow morning when the market opens, it opens at 21. That's a gap up, you know.
All right.
And I love when I wake up in profit from a gap up, you know, on a call. Gap down is when the opposite happens. It closed at 20, next morning it opens up at 19. It's a gap down, you know. So if I had to put, I like waking up in a gap down. So gap up and gaps are really important. Going long just means that you think it's gonna go, You know what I mean? You just buying something, you want it to go up. That's going long. Going short is when you think it's gonna go down and you're trying to make it. So going long, you make money on the way up. Going short, you make money on the way down. Make sense?
Mm-hmm.
Day trading, you buy something, by the end of the day, you sell it. Once the next day opens up and you didn't sell it yet, you're swing trading. So once you pass that day mark, on to the next day, it's a swing trade. Leap trading. Leaps are options that have up to anywhere from, the criteria will differ depending on who you talk to, but they'll say at least a year of time on, at least 1 year of time on it. So if I was to buy a leap, I could buy a leap for November 2022. That would qualify as a leap. But you can also say 6 months plus, you know what I mean, or 9 months plus. You could say 6 months plus, 9 months plus, or a year plus. The point is that it has a lot of time on it. So that's why it's called a leap, because it's a long-term anticipated equity. All right. So those are the leaps. The last thing I really want to cover is the orders. All right. So the order types. All right. Market order. Okay, anybody tell me what is a market order?
You buy the market.
Yeah, well, when you buy at the market price. So let's say, so remember on the option that I was showing you, it was going for like, I think, let's just say it was going for $1, which is $100. I remember I was telling you, like, when the spread is bad, I don't just buy it at the price the market is selling it. I like to do a limit order and pick my price and wait for the market to come to me. You guys are following me?
Mm-hmm.
So now let's talk about the pros and cons. Market order, you get in right away. You know what I mean? So let's say like something is happening really quick and you want to be part of that action, you do a market order, you won't miss the move. Because sometimes the price is moving too quickly that you have to market order your way in. But it doesn't guarantee the cheapest prices. A lot of time you pay more, a higher price, but you are willing to sacrifice a cheaper price to get in immediately. Does that, you guys follow? So that's the market order. It's the most basic, easiest way to get in the trade. Whatever price you see it's going for, you buy at that price. But understand, there's only one thing that moves price. Well, two things, two sides of the same coin. So can you tell me what makes price move? What moves price? Anybody know?
Volume.
What is volume? You said it, volume.
People.
Huh?
People.
It's people, yeah. But so the only thing that moves price is aggressive buying and aggressive selling. You guys understand that?
Yeah.
And another name for aggressive buying or selling is market order, because you're getting in right away. You're getting in aggressively. Whatever the price, I don't care. I'm sacrificing the price so I can get in right now. That's aggressive, because that's what's going to push the price up. You guys understand? Or aggressive selling, that's what's going to make the price go down. The only thing that moves price is aggression, because you got to remember, price aggregates. So it's about aggression. It's about piling up that aggression and seeing what's left standing. Make sense?
Mm-hmm.
All right. So now the other thing you could do, if you don't want to do a market order, you could do a limit order. Limit orders are good. So let's talk about the pros and cons. They give you control over your entry and exit price. So you pick what price you want to get in. So let's say the market is premium on the option is $1. Like they to get in right now you have to pay 100. I could do a limit order and say, you know what? I'll get in that 90. I'll get in that 80. Because you know what? I'm willing to wait for the market to come to me and I get a cheaper price. But here's the thing. The problem, however, is that I'm not guaranteed to get filled. You guys understand? Because the market might not come down that low. You know what I mean? So I wouldn't even get into the trade at that point. But sometimes I say this, it's better to miss opportunity than it is to lose money. You guys agree?
Right.
Yeah. So if I put in my limit order, I don't get filled, I'll just move on. Because when I do get filled, I make money. You know what I mean? Because if you think about it, like I remember Apple, right? So one morning Apple the it was like the 155 call, the option went up to, in the morning it was breaking out. It was like 60, 70, 80. The options was going up 90, 100. While it's moving like that, I could have market my order in. I could have market ordered my way in, but I said, no, I'm not chasing. I'm not chasing. So you know what I did? I said, I'm gonna put in an order, a limit order at 20. So instead of buying it for 60, 70, $80, I said, I'll buy them at 20. So then what happened was, hold on, let me look this person in. We got about a minute left. All right. So then what happened was Apple went up, right? Then went back down. So now when Apple dropped and came down, it hit my limit order. So I was able to get filled 10 contracts at $20. So I spent, so in the beginning of the day, it was going for $60, $70. So if I had bought 10 contracts, that would have cost me $600, $700, $800 to get in. But because I limited my order at $20, it only cost me $200 because I had 10 contracts. You guys following me?
All right.
So then at that point, the price went back up to 80, 70. So what I bought for 20 was now worth 80. So my $200 became $800. Only because I limited orders. But that's it for today, guys. We got 1 minute left. Thank you for showing up. This will continue tomorrow. The link is in the coffee. Thank you, guys.
Appreciate it.
No doubt. I'll see all you guys tomorrow.